Okay, welcome in. It's another Sunday here, and we are going to be breaking down the markets as usual. Uh, FOMC week. So, as many of you know, during FOMC week, things tend to get a bit shaky, things get volatile. There typically isn't much of a move made until post FOMC. But just to give you guys, the calendar so you can understand, FOMC will fall on Wednesday. Now, despite the fact that FOMC falls on a Wednesday this week, this time around, the important thing that I would like to mention is the market's in a consolidating phase where it has been in a range, which I mentioned last week, which would be the case, right? As I said, if we fail to break further down, then the likely situation that would happen would be that we form this kind of range until we can break out on either direction. So now from a macro standpoint, let's go through what the reports have been kind of from this week. So first things first, let's look at the Prime Book report, which is the report that covers all hedge funds and also your major institutional players. And you can see that this week, even though large and broad-based degrossing activity was taken across regions this week, the data suggests that hedge funds have been regrossing, or meaning adding back risk in equity. Okay. Now, remember, in this case, when we're looking at hedge funds, I typically say, we don't want to follow them because they tend to get whacked quite a fair bit. But at the same time, there are a variety of different forces that are going to be acting on the market. One of them being the quarter end pension fund rebalance, and then you have seasonality, and then you have FOMC. All these three things will affect the market in this week. And as people start to kind of regross into the upside, then we might see that, kind of rebound in price. One thing that stands out, though, is that options activity has come to a kind of a standstill. And when options activity comes to a standstill, that means that squeezes are less likely to happen. And so when we look at this over here, as they're saying, for early estimate, we have pensions modeled to buy 41 billion worth of US equities. That's approximately 2% on SPX if you were to use a kind of yardstick measure. I always like to tell you guys that every 60 billion or so is approximately 2 to 3%. And so 41 falls within that 2% range. And so there is about 2% upside based on just the pension fund rebalance. Okay. And this is the fifth highest buy estimate of all time, dating back to 2000 and yada, yada, yada. Okay. So you can see that. That's on the research reports. The next thing that I wanted to mention is also the fact that you have tactical sentiment. Once again, back into the close to the center. Last week we were here, a little bit overbought, and then now we're here a little bit oversold. And we have been in this, downside of the spectrum for a while. So, there's a moment at which we'll see a potential relief. Now, VIX activity, excuse me, VIX activity. Last week I highlighted the fact that up here at $29, there was a lot of selling activity, right? And the anti-VIX indicator was on the buy signal, which is the sell signal for the VIX, right? And true enough, we had that rinse happen. And so volatility has been heading back down into the acceptable levels again, no longer in the elevated range, right? Which is above your 24 on the VIX index, right? And so when I'm looking at this now, I'm thinking to myself that the VIX probably has another wash to go through. And if I look at the latest VIX, anti-VIX, right, which is up here, let me just go find it real quick. You can see here, right? The anti-VIX is still on the sell sig, which is then now going to get into the buy sig, right? So remember, the anti-VIX means it's an anti to the VIX. So anti to the VIX means if it's on the sell signal, means it is ready for VIX to be bought. So now that VIX has corrected downward, this gives us the opportunity for volatility to rise again. And what might cause that volatility? Well, you have a whole bunch of events this week that could cause that volatility, right? So your FOMC on Wednesday, and then you have a bunch of other data. Now, if you look at sector positioning, okay, positioning across sectors, different groups, let's have a look at that. So there were some things that were on this that I found pretty interesting. One of the things were the fact that energy is sitting near, the pretty low end of its momentum indicator, right? This is similar to the other one, but it's a different style. This is based on z-scores, so it's a probability. It's the probability of the event happening. Financials, you can see you don't really want to touch it. It's sitting kind of right smack in the middle. Technology is the same, but energy, it fell quite a significant bit last week. However, if you look at XOM, right, it went actually the opposite direction, right? And it's been attempting this breakout at 113 for a while now. So for this week, I would like to focus on this as a potential opportunity because the breadth, or rather the momentum and energy, was washed out last week, but XOM was strong. So there's relative strength there. And if XOM breaks 113, I'd be happy to take a bullish position short term to play this up into the 115 and then 120 eventually, right? So that's something I'll be looking at. If we reject once again at the 113, then obviously the play is back down. And this was part of my plan from last week as well. I'm not sure if any of you followed that plan. If you look at consumer cyclicals, once again, kind of almost to the upside, but not really there yet. So I don't really want to touch it. Industrials right smack in the middle, nothing to really do there. Materials group, this one has been on a downtrend, now touching that medium bottom band. And consumer staples right smack in the middle, healthcare on the bottom, real estate bouncing, utilities pulling back, but has been pretty bullish. And then small caps obviously fell off a cliff last week, right? And so if you look at just generally all major sector group positioning, you can see that majority of them are pointing downwards, which now means out of all of these, cyclicals are the ones that you really want to be watching because they can potentially bounce more than the rest. You can see the green line is cyclicals up here, and that's probably the one that has the most upside, right? And if you need a refresher on what cyclicals are, go look at the webinar that we just had recently. I broke down exactly what sectors, are cyclical and what are not, right? So that's a little bit of an update based on just macro, driven stuff. Obviously, there's going to be a bunch of reports that come out. I typically don't read the reports FOMC week because it doesn't really matter. At the end of the day, what matters is the press conference after Jerome Powell announces his rate decision, right? So when the reporters ask him questions, he'll react to them. And very simply put, if he is going to be leaning towards dovish, rather talking about the possibility of rate cuts on the table, talking about how the economy needs stimulus, talks about how things are uncertain, then the market might react favorably and rebound. If he continues the rhetoric that inflation is too high, inflation is still sticky, and also that unstable economic practices around the world are causing the Fed's job to be more difficult, blah blah blah. If he uses that kind of messaging, that's more hawkish, and then that's going to cause the market to panic a bit more. Now, let's look at both the bullish and the bearish scenarios in which this market can play out for this week, right? Which is what we typically do. So if we look at the first bit of this, well, as I mentioned last week, we are range bound. There's really no actions for you guys to take in this range, okay? Because within this range, as long as you keep bopping between it, right, you're going to continue with this up, down, up, down, up, down, which is why the whole of last week, there haven't really been any real opportunities unless you have been day trading or scalping the bottoms and then trying to short the tops, which I wouldn't recommend because you're at the end of a wave cycle, right? So very simple line in the sand here, right? Your upside pivot becomes 56.85 all the way to 57.11. Let me just do that on SPY so that you guys can kind of get that on SPY instead of SPX, because I know a lot of you use SPY. So if you look at this on SPY, right? Okay. So upside, where does the upside kick in? Somewhere around here, right? At 566, which is where your previous rejection was. So we need to break that 566 and we need to start making some demand above that. We need to break here, come back down, validate this new area as new demand, causing us to then form a reversal pattern potentially to the further upside, okay? If we make it up to here, we break out. Remember that the breakout doesn't give you a signal to buy. Why? Can someone tell me? Can someone tell me? Why doesn't the breakout give you a signal to buy?
Retrace.
Exactly. You have the potential ability for a retrace. And more importantly, there you go, Jackie just said it, you don't have a confirmation, right? What is the confirmation in a situation where you are looking for price structure to change, right? Remember that, just going through educational basis once again, when you have a wave pattern, right, and things are going down, or when things are going up, right? What confirms things are going down and things are going up? You have the structure that confirms it. So if you have a low and then a high, and then a lower low and then a lower high, that gives you the idea that something is going down. So if you're looking for the reversal, then you need to wait for this to break out from its previous high, right? Let's say this is the previous high, retrace back and form a higher low, and then you can get the entry to go higher, right? Now, for some people, they can't see this specific point. Some people just, remember, it takes time, right? So it's not that you are not proficient enough to see it. Sometimes people have struggled seeing this. So my view has always been that if you're trying to really, properly know if the market's about to reverse, the best way to do this is to look on the 15-minute and to look if you're getting two consecutive higher highs and higher lows. That means a break, a retrace, a break, a retrace. And on that second retrace, where you are going to be kind of meeting the previous resistance, which is past the breakout level, right? This should be your ideal entry to catch the third wave up, which is the longest wave in a wave cycle. You catch that wave and you're out. That's it. Okay. Where do the problems occur? Is when, no, T, I want this whole wave. I want to eat the whole thing, right? Your greed sets in, control that, right? That's your ego talking, right? It's not, you're not in this as a trader to eat the whole fish. You want just the middle, most juiciest part, okay? Always remember that. So same thing goes for this. No matter the outcome in terms of price action for this week, your line in the sand becomes 566 for upside, okay? And your downside line, or the downside pivot, is then 550, okay? So below 550, then you have pressure for potential for the downside to 540, okay? If you break the 565, then it's likely to run up into around 575 or 575, 576, something like that. And then it'll probably reject to come down for your confirmation. So remember, the breakout here will likely run a bit more, and then it'll pull back. And when it does pull back, that is the moment when you are ready to start looking at potential bullish positions, but you don't have a confirmation yet. All right? I'm making it very clear. You can be both bullish and bearish in the market. You just need to know how to orchestrate it, okay? Now, what about the bearish scenario, right? So we just spoke about the bullish scenario. That's your confirmation break 565. We call that a 565 bounce. How does that a 565 bounce? Break and bounce, right? That's why we call it a bounce. So if you are looking for the bearish structure now, that means that either, there are two scenarios for the bearish, right? The first scenario is reject 565 cleanly and then rally downward to break 550. Now, I don't personally like this scenario, okay? Because the risk to reward ratio, while it may be attractive for a day trade, right, you will have market risk and news risk this week. So therefore, anything can happen intraday, especially in the market where Trump's involved. He can say anything, tweet anything, do anything, and then the market can reverse very quickly. So while the market's already in such a big extended down wave, I do not like the idea of shorting the market into a FOMC week, okay? Now, the other thing about this is if you get a breakout, right? The other bearish scenario, you get a breakout and then you get a big rejection after that. And this is a scenario that retail traders will constantly be trapped in because they don't understand how wave structures work, right? So if you get that big breakout, but then a quick intraday sell-off back down, right? We've seen that happen before. That could be relating to gamma exposures, could be relating to market maker, dealer exposures, etc. The way that you avoid this situation is already been talked about, right? Because I just told you about that. When you have the breakout, wait for the pullback and wait for the new demand to form above the previous high, which will then give you confirmation that this is new demand that can then push the price up. Is everybody clear about the bullish and bearish plan for this week for this? If you are, just say yes. So I've broken down 2 different scenarios for the bullish, 2 different scenarios for the bearish. All of these scenarios are applicable. You just have to be prepared. And when you are prepared, when you get into your desk and you're looking at all these scenarios, give yourself more time. Whatever time that you're projected for the trade to work out or the entry to be worked out, the confirmation to work out, give it more time. 15-minute candles for confirmation, and wait for a couple of them, 3, 4 at least. Okay, sometimes it might be sooner, but you will know very clearly when things like that happen. All right. Okay, now Nasdaq's a little bit different, right? Can you repeat the bearish? Okay, so 2 scenarios for bearish. First scenario is 565 clean rejection, no breakout, just up here, then down back, right? That means that if you're a day trader or you're scalping, you could take your risk off something like this, right? This is your risk, this is your reward, right? So that would be first bearish. Second bearish is breakout, right? And then forced back. Okay. So that's how I would look at it. Okay. All right. Now Nasdaq's a bit different, right? Because obviously, we have Nasdaq has corrected more than the SPX. And now, while people have in their head all kinds of reasons why this has happened, it really isn't all that deep. Okay, it's not that deep. Nasdaq contains what? Higher and more riskier stocks, right? What are tech companies? They have higher PE ratios. They have higher earnings potential. But then based on their price, they tend to be more expensive. What does this mean? That their betas, which means their riskiness within the portfolio, is higher than usual, right? And with higher risk comes what? Higher volatility, right? So what you need to be aware here is that NASDAQ would naturally always correct more than SPX. So here, there is no comments to be made about the fact that one is down more than the other. However, I always say that because one is more riskier than the other, there is going to be higher volatility and higher drawdowns in a period of downturn, right? So I just want to make that clear so that you guys are all on the same page. Now, having said that, because NASDAQ's a bit further down than SPX, right? Because it's about, if you look at the comparison, this from the high is down approximately, it was down approximately 13 or 14%, right? And if you look at SPX, for example, just to kind of give you guys this visual so you can understand what I'm saying, right? If you look at this correction, it was only down 10.5%. So the additional 2 to 3% is the addition risk that you take, right? And so based on that, now the similar setup here exists for NASDAQ, okay? Still in a range, still not broken out of it, right? But though you can see that the price action here, SPX broke a little further down last week here. It kind of like came a little bit further down. But with the NASDAQ, it has actually been able to bounce a little more, right? But still, nonetheless, within a range. So once again, put this in a box, right? If you put this in a box like that, right? Then the simple plan here is that a break above 19,900 with confirmation, right, will then give you the upside. This will likely happen after FOMC, right? And if you break out and then you come back into the box, that is no longer a breakout, right? So that's why you have to wait for the confirmation. Now, what about the breakdown? So bullish, similar to SPX. And the breakdown, the bearish, right? And then we go into a bigger time frame here on the daily. And you can see that NASDAQ, if it does break down, right? If it does break down here, then it has more downside. It has significantly more downside, right? And so the main thing here is you break down, but if you do break down, you need a confirmation of the breakdown. And once again, because you're at the end of a cycle here, remember, this could be a bear flag, right? Or it could be a consolidation and accumulation before markup, right? So you have this, you could go either way, up or down, right? It can go either way, right? So if it goes further down, then the next level is going to be 18,400, but it doesn't get there immediately, right? What will likely happen is it'll come down, it'll come back, it'll reject, and then it'll move, right? So that's what you need to look for the bearish situation here on NASDAQ. And obviously the same thing applies for SPX here, but the SPX downside is down at 5,400, which, by the way, we've been seeing options positioning at 5,400 for the past 2 to 3 weeks. I've highlighted this last week during our prep, right? I highlighted it. How many of you guys remember that? I showed it to you guys, right? Look, 526 puts were bought on, just not long back. That was about 4 million for April. They're rolling down their put contracts, right? Now, remember, before you guys start getting all super bearish and start thinking, oh, we're going to go down, it's going to for sure crash, blah, 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 right? Remember that you're only seeing one side of the trade here, all right? So with this flow, yes, there are people who are buying 532 puts. There are people who are buying 538 puts. There are people who are buying 532 puts more over here and whatnot, right? And on top of that, you had QQQ bearish 470s come in on Friday as well, right? But you need to be aware that this is only one side of the trade, and you don't know if these are sold puts or bought puts, or is it part of a spread? You do not know that, okay? So be aware that there is two sides to this, and just be aware that the flow is there. So if the break happens and then the rejection happens, then you can say, okay, with conviction, that there is some real money behind this trade. And then you know that they're kind of aiming for this area here, right? They're aiming for this area where liquidity is, okay? So that's the way you use the flow, and that's the way you're going to position yourself in terms of price action. Now, in terms of the gamma exposure and all of that, remember that the gamma exposure at the end of the day, it boils down to key support and resistance, right? So if you just follow the plan in terms of this outlay here, you shouldn't make any mistakes. It's as simple as day. If it breaks above that level, you're going to wait for the confirmation. You'll take the bullish only after confirmation. If it breaks below the level, you're going to wait for a confirmation for rejection and then play the downside. Okay, so very simple, really, clear. Now let's look at a bunch of other things. IWM came down significantly last week, bounced on the key level 197, sorry. And now, what VP indicator are you using? VP, what does VP stand for? Volume profile? Oh, it's VRVP. Just search VRVP on this thing. You'll get it. VRVP, visible range. There. Okay, so small caps. Now they got demolished a bit last week. They were lagging, so they got demolished. Now, if this week we get a bounce on tech, we get a renewed faith on whatever, this will become a potential bounce zone. If we don't get that bounce, remember that it has to come back all the way to around 210 for a potential further retracement. Okay, that's a rejection bearish scenario. If we break above 210 and we start bouncing on 210, then that gives you your bullish scenario for a retest of 225 or 230. Okay, so that's your key pivot there. It's about 210. Okay, that's what you need to keep your eyes on. Now, in terms of the US 10-year yield, right, we're seeing this thing kind of move sideways after breaking down significantly, right? And now, obviously, the next area in which you're going to see a little bit of support is going to be right here in the 10-year yield. This is an area in which we saw previous levels, but so far it looks like, we're going to be seeing a bunch of continued 10-year yield retracement. Now, why? The main reason is because if the market is pricing in a potential higher number of rate cuts this year, that means that the Fed is going to be performing quantitative easing. Okay, so what the market prices in typically happens, right? So, but if you look at it right now, what is the likelihood of a Fed rate cut and all that? Has it changed, right? I just posted this like maybe a few days back, right? Let's have a look at it. So for this meeting coming up next week, 98% of the chance that the market says that the Fed is going to hold rates steady. In May, there is a 75% chance that the market says that the rates are going to be held steady again. It's only in the June meeting right now where there's a chance for a rate cut, where it's 60% chance rate cut, right? And so this is all going to kind of time when the tariffs hit, economic situation worsens. That's when the market's pricing in the possibility of a rate cut. You guys see how I'm thinking about this? I'm thinking a bit further long term, right? So think about the way things work, right? The tariff just kicked in, right? And I think they'll fully kick in next month, right? Then you have 2 months of data that will come out, and people will be like, oh man, the economy is getting, fucked or whatever. And then, the talks about what I have been saying for the past 6 months will come up, where stagflation will become the new narrative, right? It won't be about inflation. It won't be about anything else. It'll be about stagflation, about the economy deteriorating while inflation is higher than usual. That's what you call stagflation. And so then the market will fix it on that. And so when that happens, then the Fed can say, okay, now we actually have a reason to cut interest rates. And so that is projected now to be in June, which in my opinion seems right on time with the Q2, Q3 timing that I was talking about. But except for now, the market has front-loaded all of the risk, right? And if you look at the July meeting, you'll see that it's all messy, right? In fact, it's just a rate pause. There's a 32% chance of a further rate cut. And we want to see this 32.8% start to go up. That's what we want to see if we want to see the rate cut scenario improving, okay? So that's where the market's at in terms of pricing this in. And so if, let's say, the Fed Powell is dovish, then expect the 10-year yield to drop even more, right? Because then if the Fed is dovish, what does that mean? That they're going to start buying bonds again. Because remember, how does money get into the system? By bonds coming in, right? These are bonds, right? The bonds have to come into the Fed, then the Fed gives money out, right? So they buy bonds to allow money to come out, right? And so what happens here is typically the market tends to front run the Fed and buy bonds first so that they can appreciate from that, right? So here you can see that TLT, which is the aggregate bond market for your 20+ year treasury bonds, has been on a slight uptrend, came down to a key level from your previous breakout, and has been forming a little bit of demand here. So we'll see if this can move further up. This will move either this week or next week, right? It will move. There will be developments. And then if you look at the dollar, this is another reason why, so once again, the market's pricing in here, right? More dollars entering the market. What happens to the dollar value? If the market is thinking that the Fed is going to print more money or put more money into the system, what happens to the existing value of money? It goes down, right? Because if there's more money in circulation, the dollar gets weaker, right? So what is the market doing? Preemptively selling dollars away. You see how this works. You just got to think about it logically, right? So when you don't understand what's going on, always question, always ask. And then, you can, of course, over time, you do this, you get the idea, right? Okay, we spoke about the VIX already. Let me just show you my top setups from this week. Oh, and right before that, actually, we'll talk about Bitcoin real quick because it's your risk barometer for the market, right? So Bitcoin tried to break above your, $85,000 level and didn't get there, and has been kind of forming this upward range. It's kind of interesting here, right? But once again, my target point to add more Bitcoin, I added a very small position here at 78 or so, like somewhere around here, okay? Very small, I'm saying $1,000, okay? But if Bitcoin can come down into the 60, 67 all the way to 70,000 level, then I would gladly, allocate like a 5% allocation into this and take that upside, right? Because it would have come down pretty significantly, almost 40, 50, 30, 40% from the highs. And I'm happy with that discount, right? So I'm still looking for Bitcoin to come down further. And this is a joke now, but you guys can see I drew this golden archway and it has been holding it. I haven't changed this archway. It has been just literally painting onto it. And it's one of those funny things that just plays out, right? Entertainment purpose. This has nothing to do with technical analysis. I literally drew this as a joke, but it's playing out. So it could come down, 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 come down here, and then form demand, and then maybe we get the buy up. Now, another thing I wanted to mention is Bitcoin doesn't have to come down to 70,000 in order to get that demand, FYI. If people decide that 76,000 is the demand, then that might happen as well. So this is the reason why I say if you're trying to buy Bitcoin, don't try to time it perfectly, right? I would always take like a little bit here, a little bit here, then if it comes down, a little bit here, right? A little bit here. Break your risk up into multiple tranches, multiple instances, rather than going all in at once. The faster you get to this process of breaking your all in mentality, the more you'll be proficient at trading. I will tell you that right now. Because when you understand that the law of averages works out in your favor, then you will realize that trading gets much more enjoyable, number one. You become less anxious because you're not putting all your eggs in one basket in one moment. And the third thing is you're able to manage your risk because you don't have risk all at one focal point. And then suddenly when the dip happens, you don't have any more money to buy the dip. You see, the problem with retail is they buy everything at one moment. And then they're like, when the dip comes, they're like, oh shit, how do I even, go about doing this? So, sorry, there's a bird here who's spazzing out. But yeah, so don't put everything into one moment is what I'm trying to say. Okay. What broker did I use? I used Webull. And I bought it through ticker HODL. Van Ack Bitcoin Trust. It's on the CBOE. $20 for, one share. I like these because they are, not that super high expense ratio and, gives me exposure to Bitcoin, and then it trades like an ETF, so I can, sell it, whenever during market hours or whatnot. Now, I know some of you will be thinking like, oh, but like, what if Bitcoin crashes and I can't sell it right when I want to sell it? To me, I don't really care about those things. I'm a long-term investor, meaning if tomorrow it crashes to 50,000, I will manage my risk accordingly, right? So I don't really care about whether I can really access it at any moment. I rather own it through an ETF because it's just so much easier personally. And it's like a packaged asset. Okay. So yeah. Okay. So now let's get into some of the setups that I'm watching for this week. Okay. So first things first was XOM. This one caught my eye because energy was in a bearish kind of momentum last week. If you look at the sector itself, right, it bounced very strongly the end of the week after having that bearish price action from the entire week, right? If you look at the price action the entire week, it was actually kind of retracing downward. And then what happened was it rallied the end of the week. So XOM would be a top watch for me here because it's kind of a nice setup if I want to play the proxy on the energy sector, right? And it is one of the bigger allocations within that sector. So very clear setup here. 113 breakout bounce is more upside. 113 rejection leads to further retrace back into 110 or 108. Okay, that's been your two key levels here. So very simple setup here. Next one is Coinbase. If for some reason crypto can catch a bid, which this will only be in play if it does catch a bid, then I would be happy to take some upside in terms of Coinbase shares or leaps or swing trade if Coinbase can come down into this range here. Right here. Okay. So I would be looking for this as a potential area of support. And I think should be fairly easy for it to kind of get down here next week because it's in such a bearish price action. But this is where I would like to start looking at, bullish positions, obviously, to take as a counter trend trade, swing trade for a longer period of time. Now, what would be the basis for me to watch for a confirmation here? Well, I would like to see a sell-off and then a two-wave confirmation on the 15-minute before I take that upside, okay? So still a ways to go here, but I'm just putting this in front of you guys as a potential opportunity. Now, Tesla, everyone's favorite, right? Broken down significantly, one of the fastest sell-offs I've seen for this stock, which I really like, actually. As a long-term investor, I really don't mind that this stock is very quickly dumping, right? because when it dumps this fast, it just gives opportunity for everybody to buy at a cheaper price. And we all know that the long-term fundamentals of this business are still intact. Whether it's Elon Musk working on Dodge or whether he not paying attention to Tesla, at some point of time, this stock will rebound because people are very strong supporters of Tesla. Okay. And the market can get irrational for a long period of time before this stock comes back into fashion. But this opportunity, though, where the price is down below intrinsic value, or rather it was down below intrinsic value last week, doesn't come very often. Remember that the valuation of the stock is around $231. If you buy it at $231, it's taking on the basis that you're accounting for low and minimal growth in the business, which this business has been generating 20 to 30% free cash flows every single year, right? So I don't think that this sell-off is obviously warranted. I think the market's gone a little bit irrational, but that's okay, right? It gives us the opportunity to buy the stock at a discount, right? So to talk about that, break above, right, leads you to potential a wave structure, which then retests your $300+ level, 310 to be very specific, 300 to 310, right? So I would be looking for this kind of a structure to set up where Tesla's retracing back up into this zone and then eventually coming back down again. And then after that, going back up and then eventually breaking this thing and then changing trend to further move to the upside, right? Because you're in a descending kind of a pattern here, right? So it needs to kind of do this, right? Then that, then that, then that, right? Something like that. So descending patterns typically work like that. So nice risk off if you like the upside. However, I would wait for confirmation. So how do you plan this one? So quite simple, really, because you have this kind of, ascending pattern here. Well, a break above this level here, and then a bounce above this level here, 250 or so, would lead to the potential upside. You'll have to be aware that 265 or 270 here is a level at which you might get resistance, potential resistance. And then if it comes back down to kind of re-engage here at 250 for support, then you'll have a further upside at around 290 to 300, which is what I'm looking at. Okay. So that's how I would play Tesla upside. Now, what about downside? Well, it's very simple. If it rejects 250, 255, somewhere here, right? If it continues to reject this area or breaks out and then fails to go further higher or comes down and just continues coming down, then that's going to be your downside scenario. Now, I, once again, do not like the downside scenario, right? Because the risk to reward ratio is stacked to the upside, right? Just think about this from the risk to reward ratio standpoint. If you take your downside here, you're taking all of this risk on, right? You don't want that, right? The upside is what you want because you take on this risk here, but then you have this much upside, right? So I would rather the upside than downside scenario here. The next one is Amazon. However, I got to say that Mag 7 are still taking a back seat in this market. And as I mentioned in last week's weekly prep session, I said, as long as Mag 7 doesn't come back into the driver's seat, it's going to be a very difficult situation because the market's not going to be able to kind of expand in terms of market cap. And so you need to understand that as long as the big players, the mega caps, don't rebound, then it's very difficult for the market to rebound. And that will only happen when there's some form of, inkling that monetary policy is going to improve. Okay. NVIDIA, I posted the chart last week that we were coming down in a downward channel and we bounced off the 105 level, I think was the key level for Gamma, moved up back into intrinsic value right now, which is at 122.33, right? And looks like it might go further up to potentially reject at around 130, 135. Okay. So that's that. And yeah, I think that's all I have to cover. Chinese markets still very bullish. I've been hitting these, upper levels of Fibonacci extensions here. Now approaching the golden pocket up here at the 38.2 and 23.6. So if it rejects here, then it'll likely come back down into, your previous area of resistance. And it'll turn support here and then go for another round later on. But if it breaks above, then it's likely to run up into 26,000, which is where your 61.8 is, and then it'll reject here ultimately. So a little bit more upside or potential rejection here with the Chinese equities, which is your Hang Seng Index. And yeah, that's all I have for you guys today. I think I covered most of the usual suspects. In terms of ticker breakdowns, let's do that pre-market. I will hold a pre-market session since Andrew's not around, so we at least we can get some work done. So I can do chart breakdowns pre-market if you guys need, but I open it up to any non-chart related questions now. If you have questions about the market, or if you simply want to ask anything about this week. But in all case, I hope that this breakdown was helpful for you all. Yeah, no worries, of course. No problemo, no problemo, guys. Thank you. Should we wait till after FOMC for possible hard rejection? Yeah, I personally would not like to trade until FOMC is over. This is just my rule. I don't think it's worth it. There's a lot of things that happen in the FOMC week. You have a very finicky president who is constantly tweeting things, right? FOMC will be a event. I mean, it could be a non-event if Powell just decides to be neither dovish, neither hawkish. He could do that. Then it becomes a non-event. But if he leans one way, then the market's going to take his guidance, right? Should you wait for the rejection? I personally, it depends on what kind of a position you're talking about, right? If you're thinking long-term position where you're thinking equity or leaps, then my opinion on that is don't try to time the market, right? You should be buying in little bits and pieces whenever the market corrects downward. That's the best way to deal with these situations. That way you're averaged into your price. You don't need to worry about timing it perfectly, right? I don't feel comfortable buying the dip at this time because of the tariffs and 47 tweets. Yeah, and that's fair. Everybody has their own risk tolerance, right? We all have our own areas in which we're comfortable. For me, I haven't allocated, all of my cash pile that I needed to, right? I haven't. I still have like a couple 100,000 that I need to allocate. What is your view on long-term position on NVIDIA? Well, you just missed out on the potential for a very, very cheap entry, which was down here at 105. If you're buying it at this price, you're buying it at fair value. Just know that. So it's not a bad price to buy it. Of course, if you don't own it, it's one of the in my opinion, one of the companies that will be successful and around for the next 10 years. So one headline about its, business structure or other competing technology shouldn't, waver you. If you are a long-term investor, you should do your research about the stock. Why are you investing into it? Is it because other people are telling you that it's a good investment, or is it because you think it's a good investment? Because if somebody else told you it's a good investment and you bought it, then when something bad happens to the stock, your belief is shocked, you sell in panic. But if you know that it's a good business and you believe in it and you have done the work around knowing why this is a good business, then nothing can shock you, nothing can break you, right? So if you're planning to buy, then you just keep adding on the dips, right? You wouldn't want to time it perfectly to try and purchase it perfectly at 105 or try to perfectly purchase at $99 or whatever, right? Just buy bit by bit by bit by bit, and then eventually rebounds. And remember, semiconductor sector is a very cyclical sector. That's the other thing. So earnings are going to be cyclical for this business. Some months will be high, some months will be low. If you can't stomach that, don't buy it. Actually, that's just a rule that applies to all stocks. If you cannot hold through a good stock with a 50 to 60% drawdown in a year, you shouldn't be invested in it. I noticed that the indices have been decreasing in volume in Tesla for a couple of days. Does that mean sellers are drying out despite making lower prices on some of those days? Possible. There's a possibility that that's happening, but it's also because people are just taking a break before FOMC, right? When it's FOMC week, nobody wants to put on excessive risk. Everybody knows this. Until Powell comes on and says what he needs to say, right? He can move markets, so why would you want to take that risk on? So naturally, what happens is volume dies down because of that. Try to avoid confirmation bias. It's because you are looking for a bullish opportunity. So then you think that the decrease in volume means that sellers are drying up. Ask yourself, why is the other side of this happening, right? Couldn't it be that people are waiting to see what happens next so that they can sell more? That's also a possibility, right? Always look at both sides of your thesis, is my view. Okay. Any other questions? My view is be non-objective this week. Don't take excessive risk and wait for after the presser to see what's going on. Price action will confirm. Give it a day or two. Let things play out. Dust settle. Then make your decisions. There's absolutely no reason to rush. All right. I don't see any more questions, so I'm going to end this recording and then I'm going to let you guys see if you want to